very much want to make this interactive. We're going to see what we can do about bringing together a couple of themes and maybe helping people think about where things are going forward. But we really do want to hear from the audience, especially if you have different views of what you've heard here. If you think there were things that were left out that really needed to be discussed. Obviously, a couple of us were here through most of the sessions, but obviously we didn't, or most days of the conference, but we weren't at all the sessions. So I might say, well, there wasn't enough about gas. Well, that's because I went to the oil sessions. So, that's what usually happens. But maybe gas is pretty important. Luckily, one of our panelists here knows a lot about gas and does a lot of work in LNG and in other things. So the panel here, to my immediate left, is Ferdinand Feshiwaki, who is founder president of FGE Energy, originally called Feshiwaki Analytic Consulting Services, and something like that. And before that, an East-West Center person. He is a past president. He even arranged an eclipse for his meeting, which no other president has done, but I know it, in Hawaii. And he didn't spend all the money, which had been done a few years before by someone else. So, Ferdinand is an old and dear friend. There's nobody around that knows more about what's going on in Asian markets and energy. There may be nothing more important to know about than Asian markets. I call China the Saudi Arabia of the demand side. And we certainly have had a bunch of things going on in China that has led to a great deal of confusion about stuff. But I think I mentioned yesterday in one of the sessions that for September of 2016, the largest importer of oil in the world wasn't the U.S., it was China, over 8 million barrels a day. And on a net basis, it's actually been ahead for a while. So it's something to pay a lot of attention to. Next to him is Jeff Curry, who is one of the most well-known caretakers of the other stuff that we don't want to worry about. That's the fact that oil as a commodity has a very big influence on the oil business. And Jeff is the one that's out there kind of looking at other commodity markets, about the general economic tone, about the general commodity markets tone. And I think that certainly is part of what's going on. Jeff and I have done a number of meetings together. We tend to be bears on price for some reason, but he sometimes will lose the religion and we'll get a much bigger number for Goldman Sachs, but that's a good deal. And lastly, the Honorable Adam Ziminski, who will tell you that the Honorable is a nice title, but it means he has to fly in the back of the plane. You know, that banking business was so bad after all. Adam is the administrator of the Energy Information Administration. He has done just a spectacular job in advancing things on a whole number of fronts. With some help from a few of his predecessors, Dr. Russo in particular. And so we're now getting a level of frequency on the data, breadth of the data that we haven't seen before. So we thank Adam. With all that, Ferdinand's going to have to catch a plane, so I'm going to let him talk first. And if there are some specific questions about Asia, about gas markets and things like that, maybe we can entertain them early. And then we can move on to Jeff, and then we'll move on to Adam. And I might have a couple of things to say at the end, which I mostly have said before, about Saudi Arabia, about IPOs, about oil prices in the longer term, and things like that. But with that, Ferdinand, why don't you start us off? And since you have been here the whole time, seeing at least one of each of the plenaries and whatever, do you have a takeaway from here about the major points that you see that you may agree with or not agree with, but where are we now? I mean, we've been in a very good market that then turned into a very bad market, and now we're back somewhere in between. And part of this panel is to answer the question, what next?
You know, I've been involved in this organization for a long time, and still half the papers I don't understand what they're saying. It's either too many differential equations or people who rely on the network, which doesn't really have the access to the strategic thinking. But lots of the useful presentations were there. There were several oil sessions. I must confess that renewable energy and energy efficiency is not the ones that I attended religiously. There were a couple of sessions on LNG that I attended. One, Marianne told me I should have attended the second one. That people who remain super optimistic about the future need a dose of reality check. But basically, I think if there are any takeaways, is exactly what you said, that there is now, everybody knows that below $30 is death, and above $70 is the same issue as before. So there have to be somewhere in between. So where we go in between is the question. And the oil market hasn't been free since the day oil was discovered. Oil market has been free only in the past 2 years. And free market is not such a good thing. It's very tough. People think that, oh yes, it's like oil-to-oil competition, gas-to-gas competition. It doesn't mean that the prices are lower or more stable. It actually makes it quite difficult. And for us, in our business of trying to forecast, it makes it extremely difficult. We don't like that. We like a free market within boundaries. Please define a floor and a ceiling, and in between, I can be all good forecasters. So the discussion of where things will settle, I think nobody reached a conclusion that we had. Given opinions about yesterday discussions about oil, whether to the extent that Buckler, Permian, Eagle Ford can provide the ceiling. We always thought that Eagle Ford is the most expensive, and Mariana says, no, actually, we can produce some very cheap there. So obviously, there are big variations between different areas, but there seems to be a ceiling, and that ceiling, to me, my interpretation is that the ceiling is probably not higher than $60 a barrel. But the question is that to relate this to some other part of the business, if the price of oil is less than $65, all US LNG is too expensive to be sold outside the world. And if you haven't done it, if you haven't sold already, then you're in trouble. If you want to do new projects, you have to give up your capital costs from the beginning. LPG exports are all uneconomic. So if you don't reach $65, a lot of things go wrong. Far beyond the revenues for the countries and the oil companies, there are many, many other things that make it imbalance. Does God want the price of oil to go to $65? I think eventually yes, but we don't know when.
Okay, let's stop. That's good. One thing that occurred to me, when I first went to work for the International Energy Agency, the lowest price was the best for the consumers, and the highest price was the best for the producers. And there wasn't a whole lot of give and take. In fact, when I worked for Helder State, then I couldn't use the term OPEC. I had to say producer group. And they were clearly the enemy. And then when Robert Prittle took over, we softened it a bit, but this is a total Thatcherite, so there was some fairly strong feelings on his part about stuff. He's the one that closed the coal bids for Maggie. But there was some progress, and now we're in a world where the producers and consumers have been getting along, dealing with some mutual interests in having sort of a fair playing field for environmental policy that takes into account the value to consumers and to producers of having oil and a price range we're talking about. This is a major step from when this organization started. Energy independence was what Jim Sweeney and I were told, and we looked at each other and said, what happened to comparative advantage? Why don't we just take their cheaper oil and add value to it and sell it back to them and recycle the petrodollars? Well, but Project Independence never died. It's still out there. We heard a lot of energy security. One of the things I would like is to hear that less. It's the excuse for most of us on the Hill that means you don't really have a story to tell, so you're going to pull out energy security as a reason. Jeff, why don't you take us over into your world, where oil is now become a commodity. Phil Verlager, who was here yesterday, and I were asked to do a counterpoint for Euro money back in the early 80s about whether oil was just a commodity, and I said, absolutely not. It's just too political, it's too concentrated, it will never be just a commodity. Well, there's one for you, Phil. I will congratulate you for getting that right. But it is now a commodity, and it sure does make it more interesting reading the Wall Street Journal in the morning, because there's so much that affects oil markets. I have a slide I do for client presentations that says no oil market is an island. And I think Jeff very much shares that. So.
Well, there's two things I want to talk about that connect oil to the rest of the commodity complex and the rest of the economy. The first one is the high correlation with oil and dollar. In fact, if you plot the dollar on a trade-weighted index basis, going back to 2000, you plot the oil price on a chart, you don't know which one to speak up. Oh, can you hear me now? Yes. Okay. So if you plot the oil price and the dollar on a trade-weighted index going back to 2000, you put them on the same chart, you're not going to be able to tell the difference. That is how highly correlated. And it's both a low frequency as well as a high frequency. The second observation we have to take away is if you plot oil and copper, you have the exact same correlation. In fact, actually, if you take the correlation of oil and the correlation of the dollar and you put them against copper and the dollar, they're highly correlated. What's the common denominator between them? It's the fact that they're both dollars. Now, I'm not a believer in the view that is that when it comes to correlation, because you don't have any argument to stand on that it's a demand-related correlation. And the reason for that is given the fact that if you think about the volatility in oil, you know it can go up and down 25, 30% in 1 year, 50% in 1 year. While you're lucky when you see something like the euro move around more than 100%. So there's no way you can argue that it's a demand for that. So what is driving this? Actually, we would argue that it really is driven by what goes on in terms of global trade. And it's everything. So if you think about global trade is roughly about a $15 trillion market, to put it in perspective. 34% of it is commodities. So what you find is even the price of machinery coming out of Germany and other parts of the world is also correlated to oil. So when we think about what oil is doing when it goes up and down, it's actually either increasing monetary supply or taking monetary supply. And so we think about in the 70s, we all thought that, okay, if oil prices go up, it's damaging the global growth. What have we learned over the last decade? Oil prices go down, it's damaging the global growth. We learned that in the first quarter of this year. So what's the only explanation? Is that oil creates liquidity in the air. And that's what creates that correlation with the dollar. Also explains why, when you look at what the Fed tried to do earlier back in December of last year, it tries to raise rates in a very sharp downdraft in the oil price and got itself into serious trouble. Because if you think about what the oil market is doing out there on a global basis, it's pricing the petrodollars, the Chinese dollars, the Brazilian dollar, all of those dollars sitting in those emerging markets and banks. And so that connection really needs to be taken into consideration when you think about what happens to what the Fed has to do or what happens with the oil market. And you think about what we saw this year. In fact, I like to say, what are the three big macro drivers of the world right now? Oil, Fed, and China. And when we think about how do they interact with one another, that's what drove prices all the way up to $140 a barrel back in July of 2008, and $26 a barrel this year. Which is why I don't have a lot of confidence in our price level forecast, because if you change any of those macro variables, you can move those costs around very quickly. But actually, I think it's just worthwhile to tell the story. Actually, I'm going to ask this question. I think everybody in this room knows what the highest oil price ever achieved was. 147 on on roughly July 14th of 2008. Can anybody tell me in this room what the weakest U.S. dollar ever achieved was? What was the euro? Same day, 1.61 on the euro. When was the strongest dollar ever achieved on a nominal basis? Back in February of 2016. So you can't argue that the two are completely interrelated. So let's go over just how that story played out over the last decade. You start off, actually, the thing that was the exogenous event that had everything occur over that last week was China with a huge increase in investment off the back of being accepted into the WTO. And that increased investment, increased demand for commodities, and put upward pressure on commodities. We started to create that excess savings. As that excess savings began to take off, we started to create, I actually don't like to call it a savings glut, but remember it's dollar. We've accumulated too many dollars out there to reaccumulate. Puts downward pressure on the dollar. Now, if you think about now what creates the connection to copper and the rest of us, is as the dollar gets weaker, what happens to the Chilean peso, the Russian ruble, and the rest of it? They get stronger. What happens to the cost of producing oil in Canada, the cost of producing copper in Chile, the cost of producing oil in Russia? It starts to rise. There's upward pressure on oil prices. What do higher oil prices do to the U.S. over the time? Kill off growth. How does the U.S. respond? More accommodative monetary policy. What does that do to the dollar? Weakens it one more time. What does that do to the cost structure? Puts up higher pressure. How does the Fed respond? More accommodative monetary policy. See how it just cycled on itself until you got to the dizzying heights of 08. But what precipitated as we went into 08 is that you continue to put more and more leverage in the system as it continued to put downward pressure on the distribution. So that's how you get that relationship. And then we think about the current environment and how does it create downward pressure on oil prices, is once the machine starts to turn the other direction, and you have the Fed wanting to increase rates, you had shale putting downward pressure on oil prices through the supply channel, and you had China now beginning to delever. In fact, we like to call it the 3 Ds. You have China needing to delever, which now you have them slowing down and taking trade out of the system. You have oil dealing with the inflationary pressures of shale, putting downward pressure on oil prices. And you have the U.S. central bank having to raise rates, we call divergence in central bank policy. So what do they all three do? Well, the central bank needs to higher rates. What does that do? Put upward pressure on the dollar. What does China need to do? Delever, which slows growth out of China. And what does oil need to do? Deal with the surplus, which puts downward pressure on what? Put the three together, they just feed off one another. It creates a lot of downside risk. So now I just want to finish with what happened this year. All three, China, the Fed, and the oil are all trying to fight. So we can start with China. What did they do after February? We went to $26. China was cratering. The dollar was reaching all-time highs. How did they all three respond? Started off with China, inject more credit into the system to fight. And got growth going again and propped up commodity prices, which then gets the blood flowing. In fact, you look at what did they do in coal recently? They just cut 15% of their coal production, 50% of overall coal output. By cutting 15, they got coal prices up and they got the whole system going. Put up gas prices, got energy prices going again. So what do we see? What did the Fed do? They got cold feet as well come around May. They start to take a more dovish stance. That reinforces higher oil prices, higher commodity prices, a weaker dollar. Going back to the old days in the 2000s. Then what did OPEC do this September? Reverse course. Will any of these policies work? Absolutely not. So start with OPEC. Is cutting production in the face of fast cycle shale production a wise thing to do? Absolutely not. They work for a couple of months, those shoot themselves in the foot. Was the Fed reversing course a wise thing to do in the current environment? Absolutely not. They have to raise rates. Was it wise for China to go back and re-lever up? Absolutely not. So you got to pay the piper here eventually, which is going to be painful. Now, which one of the three is going to trigger us as we go into the end of this year, early next year. I don't know that they all need to reverse themselves. In fact, you look at China, it does this every single year as you come into April, May. It's the credit injection. They get the economy going back up to around 6.5%. They take the foot off that accelerator, you're going to cycle this thing back down. So that's how you got to think about the macro space. And I would put a lot of weight on downside risk because all three reverse policy in the face of an unsustainable dynamic. China can't re-level. OPEC has to deal with the reality of the shale. And the U.S. Fed raise rates. Why does the Fed need to raise rates? It's destroying the financial sector. You can't have a flat yield curve sitting at 0% interest rates. So I'll leave it at that.
Okay, that's great. I had Jeff on my annual oil market panel at Oil and Money, and with us was Antonio Marino, who was at Repsol's chief economist, and he had his 3 Ds, and Antonio had his 3 S's, and I said, figures, you put a whole panel together of economists, it's going to be S and D, S and D, S and D. That was not a setup either, so that was. I'm going to give Farragut a chance before we go to Adam on the view that you just heard of China. Would you make any modifications to that? Do you have a different view from that?
Well, Jeff is talking about the macroeconomic issues. As far as oil demand in China, it's doing pretty okay. But what's happened in China is that there are 3 factors which impact oil demand. One is that basically gasoline revolution in China, which is carrying the market. Diesel demand in China is down by 4%. Gasoline demand officially is up by 5%, but if you add the aromatics that they import, it's actually about 11% growth rate. So that portion happens. Then the Chinese production of oil has been flat for 25 years, against everybody's expectation. And what they did is that they kept pumping EOR into the system by trying to keep the production up, and that added costs. So now the different fields, the cheapest fields are about $45, $50, and some of the more expensive ones up to $70 a barrel. And when the price of oil was $100, they sold at home and kept the extra money, and they went outside and bought everything. That's how the Chinese became rich. The Chinese companies, you go to their offices, they serve you dinner in gold-plated plates and cutlery, and they have waiters with white gloves serving them. It's really sort of a very, very sort of high-class aristocratic society, and now suddenly they all become poor because they have to produce the oil at the same price and sell it inside of China for under $50 a barrel. So their money is gone. But the demand side, on gasoline side, doing pretty okay. The drop in the production, 250, 300,000 barrels per day. The drop in production in China is as big as the demand growth. And then on top of that is the strategic storage. So we have about 700,000 barrels per day more imports into China this year than last year. And for next year, we see the number will be about 750,000 barrels per day again. So the Chinese market will support the international oil market in more ways than just the demand growth by itself. And it remains an important factor. In terms of demand growth, India for the first time are growing faster than China, tripling the growth rate from 2 years ago. So the demand side for the oil is still doing pretty okay. If the prices go much above $55, $60, I think that the gasoline revolution will stop. But until that, I think you cannot underestimate the strength of demand, which comes in for other reasons than just economic growth development by itself.
There's a lot of Chinese.
Yes.
Population is a huge driver. And in fact, the latest numbers from the customs were down 9.8% on the production side. So I agree completely with Farragut that these fields have been pushed so hard. It's like watching Canterell. When it went over, it just went over. But there's a verb for that. It was salmon water.
But the Chinese have spent money in Mexico and India. they spend money, but at the end of the day, you can't keep a person who is getting old alive by vitamins all the time. It's old.
Actually, it's probably worth going on how China drives the oil price more directly, because it's not the impact when China slows down. It sits on them. You've all heard about the $4 trillion that they send. The way it impacts the oil market is if they slow down and then you have a weakness in the RMB, then everybody wants capital flight out of that country, right? You think, oh, that RMB is going to collapse. You want to go to the central bank, take your RMB, give you the dollars, and get out of it. And if you start pulling the dollars out of that $4 trillion, they graded from 4 down to 3.2 already. And that's what got us that downdraft in 2015. So the way you think about the connection is you start to pull that capital out. What does that do to the dollar, pool of dollars globally? It tightens it up, right? You take the supply of dollars out. What happens to the dollar? It gets stronger. The dollar gets stronger. What does that do to oil?
But the question is that, you explained it. Is there any logical relationship about this inverse relationship? Or is it statistically significant? I understand it's statistically significant, but I cannot still in my heart be convinced that what is the logical reason for this relationship? Are we not going to have a situation that dollar and oil go up at the same time? Or is that never going to happen?
The relationship comes from the fact that oil creates dollar in the sense that if you look at, let's take trade finance. In fact, that's where the linkage happens. You take, and again, remember I told you oil is correlated to everything. So basically everybody's an oil producer, even China's an oil producer. You look at their reserves, they go up and down just like salads. So if you think about the money supply out there is that if trade finance is $15 trillion, it's just like one big repo market. It's like, what is trade finance? It's essentially, I take my barrel of oil and let's say, actually here's a way you can see how it happens. Let's say I'm Valero and I want to buy a barrel of oil from Southern. I'll call up SocGen. Now this is important. We'll never call an American bank. It will always be SocGen. Why do the Europeans dominate trade finance? The reason why has to do with the fact you have Sallie Mae and Fannie Mae in the United States, so the regulators don't have to worry about mortgages on U.S. bank balance sheets. So they regulate them on risk, so not on risk, but on leverage. This is important because what the trade finance is told you $15 trillion. So it's balance sheet hog. If you have a balance sheet hog out there, you can't regulate the banks on leverage. That's why European banks do this. It requires lots of leverage but no risk. So let's go back to Valero buys a barrel of oil from Saudi Arabia. So they call up SocGen and go, give me a line of credit to buy that barrel of oil. That tanker pulls up in Corpus Christi, drops off that barrel of oil. In Paris, they're going to get that line of credit is going to go to credit to Saudi. Okay, we just created dollars outside of the U.S. Now, that's still in the purview of the U.S. Federal Reserve, because they can see that Valero has a liability to SocGen in Paris. Now let's go to the next level. Shell calls up SocGen and goes, okay, give me a line of credit. I want to buy another barrel. I want to buy Saudi's oil. Now it's Dutch, outside the purview of the U.S. Dutch current account that is now waiting. As soon as that barrel of oil hits Rotterdam, what happens? SocGen credits another one. This time you just created dollars outside of the purview of the U.S. Federal Reserve. And this goes on and on and on. So now think about this. It's a $15 trillion market. Oil prices start to go up and down, up and down. What happens to the supply of money? It starts going up and down, up and down. Now you think about what is it going to do to the supply of dollars out there? It's going to make it go up and down. So you have a pool of dollars that sit off the coast of the United States. They're a big pool. You put it all together, it's roughly about $8 trillion. The U.S. M2 is $13 trillion. And you can put that in perspective. It's pretty big.
Hold that thought. We haven't given Adam a chance to say anything. And he actually wrote some stuff that looks like cheating.
Yeah, I'm actually enjoying listening to this.
Adam is another of our past presidents and a long-time friend of mine, but also has been president of NAPIA and some other things. So he brings a whole different set of perspectives into our organization, into the EIA job, and it really does show in terms of, it is almost been, and
So,
it's honorable. So
Dave, it's a pleasure to be here at the USAEE meeting in Tulsa. It's sharing the stage with a premier journalist, a successful oil consultant, energy consultant, an entrepreneur, and with a representative of one of the premier investment banks in the world that's stayed in the commodities business and is doing good research. So, with that said, let me just comment on some of the uncertainties that make this area so difficult to forecast, and then I'll make some forecasts. Three of them. Knowing what's going to happen with the economy. So, you all talked about that. And it's not just China, but it's the United States and it's Europe and this situation that we're in that Jeff indicated. I'd say another one is geopolitics. Is something going to happen in Venezuela between now and the end of the year? I've been talking about Venezuela for some time, actually, as a source of serious potential volatility in the markets. And that's just, for starters, Nigeria's got some serious issues. So we go through that all over again. And then I think there's another one, which is more of a longer term thing, but what's really going to happen with climate policies? Where are we going with that? And where does that leave hydrocarbons in general? Where does that leave the oil markets? And layering in on this, since this is an energy economics group, I think you always have to think about one of the classic problems associated with oil, and I think probably somewhat really energy in general, is very low elasticities of both supply and demand with respect to price. So those low elasticities mean that you have to have sharp moves in price to change the needle a little bit on either the supply or the demand side in the short term. And so that's always a problem. So given that as an introduction, let me just go through, and this will be a little bit different conversation, what I think are some of the frequently asked questions that we get at EIA on 3 or 4 different topics. And I'll do this very quickly. Brent crude oil prices. What does EIA think there? Well, we think it's going to average about $43 this year. We think it's going to average $51 next year. Our $51 price hasn't changed very much. It has gotten flatter, so we're raising the front end of 2017 and lowering the back end of 2017 a little bit. Why are we doing that? The market actually has reacted positively to the OPEC meeting. Now, whether that's going to last through the end of October meeting or not. Is it end of October?
No, November.
Thanksgiving. I think they're doing it on Thanksgiving.
Just go last until the
Right.
issue that long.
And then U.S. production. We're actually seeing in our numbers that U.S. production is more robust with respect to prices. So the rig count is coming up. People are actually putting money in. There's lots of interesting reasons for that with how the companies are reacting. Crude oil production. We actually think that there'll be a decline of about 150,000 barrels a day in U.S. production in 2017. That's after a decline of almost 700,000 barrels a day this year. So the decline is slowing down. We actually think that offshore Gulf of Mexico will go up by a couple 100,000 barrels a day in 2017. There's a number of, I love the latest names, the 2 fields that are going to increase the most in 2017. Son of Pluto. I wonder if somebody saw, what was that movie about the fraternity? I'm trying and Horn Mountain Deep. So the decline in the forecast decline for 2017 is less. So we're forecasting less of a decline than we were in September And we are looking for this output shift to really kick in the second half of 2017. What about OPEC? I always think of myself as being one policy comment away from returning to the private sector. And, EIA is a statistical agency. We're not a policy agency. We're supposed to talk about numbers. I'm supposed to stay out of the policy debate. Our numbers are to inform economists and policymakers, not to take a position. But, well, what about the OPEC agreement? One of the things I think you have to keep in mind is our forecast for OPEC production next year, I think it's 33 million barrels a day. That's within the range of what they were saying they wanted to do. The meeting is November 30th in Vienna. We'll see what actually comes out of that. Markets still matter. USAEE companies are accelerating their activities. I spoke with a couple of E&P company leaders in Houston a few weeks ago, and they're talking about putting more money in. So that's kind of an interesting one. Natural gas, we're going to go into the heating season with a lot of natural gas in storage. I think some of that will come out, so the natural gas markets will start to rebalance by 2017. The winter fuel outlook in the U.S. is actually kind of an interesting one. If you are on natural gas, propane, or heating oil mostly up in the Northeast in the U.S., your bills are going to be a lot higher, somewhere between 25 and 30% higher. Electricity, not so much, and the reason for that is there's a lot between the fuel and you in the electricity markets. But if you say, well, why are they up? Well, about half of the increase is because it's going to be colder than last year, which was unusually warm. That's just that we have a normal winter. And the other half is because prices are higher now than they were last winter. But if you take a longer view, just a 5-year view, bills for oil, heating oil, electricity, natural gas, and propane are right in the average of that 5-year period. So it's not like it's going to put a huge strain on consumer budgets or be a drag necessarily on the economy. I think that's kind of an important thing to keep in mind. And then finally, since Jeff asked a question, I thought I would ask one too. He wanted to know, could you remember when oil peaked and when the dollar bottomed? And my question is, who in this audience has heard of the Black-Scholes algorithm? Black-Scholes. This is great. This is an economic audience. Everybody's heard of Black-Scholes. So Black-Scholes was designed to take current volatility and use it to forecast prices in the options market going forward. Right? So, brilliant. Got the Nobel Prize for that. Before they nearly killed the entire financial market, right? We at EIA have taken Black-Scholes and we've run it in reverse. What we say is, let's assume that the WTI options market prices are okay. Put those into the Black-Scholes algorithm, run it backwards, and then see what that says about volatility in the short run. You can do the same thing for natural gas. And here's what it says. With a 95% confidence level, I can tell you that between now and the end of 2017, WTI crude oil, which is a little less than $50 today, will be anywhere between $25 a barrel and $90 a barrel. And natural gas, the same confidence level will be somewhere between about $1.50, $2, and $6. Right? So what does this say? Now, first of all, please don't write your congressman and tell him to cut EIA's budget. Because they like, what use are you? The options market is composed of producers and refiners and trucking companies and airlines and who else is in there? Hedge funds and investment banks. Sometimes just balancing customer orders, sometimes taking their own position and that kind of thing. Okay, so in theory, the options prices ought to be pretty good. And those people that are in the options market are doing things for mostly, I think, for financial, economic reasons. Okay, so now, why am I saying that? And the answer is, I think what the reverse Black Scholes tells you, based on the best information that's out there, is that it really is a huge range. This isn't like some geeky people at EIA who are doing supply demand balances that are telling you what the price is going to be. This is the market telling you that all of those things that I mentioned in the beginning, the economic outlook, the geopolitics, the issue of domestic politics, who's going to be the president, and all those kinds of things really matter, and the dollar matters, and what the Fed is doing matters, and what's happening in Iran matters, and all of those things mean that it's really hard to get down. So what's the takeaway from that? If you are actually in this business, and you have to have a point forecast, and we do provide those. I told you what they were at EIA. You really should think about Plan B. You really should think about Plan B. What are you going to do if it really is not what your central point forecast is? So for that,
Ferdinand has a question for you. I do remember, and I don't know whether Jeff was there or not, somebody said Black Scholes to Ian Taylor, who runs Vitol, which is the biggest trading house in the world. And he said, screw Black Scholes. So, your question.
I think Black Scholes is a tool. It's a tool for trying to understand something. I don't know that every once in a while, EIA gets accused of misleading the markets with our data.
Really?
Yeah. And I keep thinking that it's an odd position to take. I talk to a lot of traders, and I don't find traders put positions on when they have customer orders, generally speaking, or if they have a really strong conviction of something that's going on in the market. That strong conviction is going to be based on a whole series of things. Not one. In fact, last night we were talking, nothing in life ever happens for one reason. There's always multiple things that are happening in the marketplace.
I bet that's not the answer to Ferdinand's question. So let's let him ask it, then I think you're going to have to run, right?
And about, it's not about 30 minutes.
Well, 30 minutes?
Yes.
Oh, God.
Let's open it up.
No, I had a question actually both for Adam and for Jeff. You mentioned about base of $51 price next year, and I didn't understand Jeff if it was a lower number. But can I ask that both of you keep the Saudi production at 10.7 million barrels per day flat? And if I tell you that the Saudi is 1 million barrels per day lower, would you change your forecast?
Right. If you could assure me that you knew what Saudi production was, it was going to be $1 million.
Well, I can certainly assure you it's not going to be 10.7.
This is we stopped forecasting individual OPEC countries because what we found was that showing a history of production numbers for OPEC countries whose transparency is not as good as some of the data we get from the International Energy Agency on the developed country numbers. What we found was we were just raising more geopolitical questions than we as a non-policy agency wanted to get into. Why are you showing our numbers higher or lower than our official statistics?
Scenario planning.
Right.
Scenario planning.
Scenario planning. Venezuela, Saudi Arabia falls into that category, as does Venezuela. Venezuela worse than Saudi Arabia, I think, in terms of what the production numbers are. So.
Except in Venezuela, the production falls by itself in Saudi Arabia.
Right.
Production.
Right. So the other thing, and again, if you go back, I think you'd have to say, if everything else was being held equal, and we thought that Saudi production was going to be 1 million barrels a day lower, would we have a higher oil production forecast? Probably.
We have it going to 10.2 by first quarter next year, so we have it coming down naturally, just for seasonal reasons. If we did see the full 1 million barrels per day, which is what we pencil in we would take it down down to that. Now, what would this do? Push prices. Right now, we have an end-of-year target of 43. Push prices into that 55, 60 range. They wouldn't sit there long because you'll get an immediate response out of the shale. In fact, we'd say you'd be at 500,000 barrels per day out of the shale within 6 months, which would then start to offset any type of decision by
So $55 to $60 would bring it to the barrels per day.
6 months. We've already been out to 3 months just within the Permian Basin and the Horizon drilling. We've stopped the decline in that period of taking production. So you get to that 55, 60, then you start to open up potential for the marginal fields and Eagle Ford as well as Bakken. We would estimate 6 months, you're up 500,000 barrels per day. Then you have a 200,000 barrel per day response to the loss. That 55 to 60. Then you put on top of that, you get a brownfield response out of places like Russia, Latin America, and you will offset it. So we would say your production, if you do get the full cut out of that, you bounce up into that 55, 60 range, and then you just trade right back down to look forward to budget for next year.
So Jeff has raised an interesting point. Since our forecast for prices for next year is a $51 average, and by the end of 2017, we're actually getting prices up into the range between 55 and 60. Then what I would say is in our models, if we actually had a $43 number rather than a $51 number, we'd have lower U.S. production, maybe lower production in a few other areas, and that would tighten markets up quicker. So it would result in a more rapid rebalancing of the markets, which then might push prices further up. We are seeing U.S. production respond at the $50 a barrel level, but it doesn't seem to be at that price level. We don't see it as being enough to completely undercut the markets.
I must say that to me, these responses are really sound very, very high. I mean, you have a decline and then you come back on. But on a sustainable basis that you add $55, you add 500,000 barrels per day, it sounds to me very high. The people that we know, we talk to, do Permian, Eagle Ford, Bakken, I don't think any of them subscribe to this.
So fair in our numbers to get that kind of a response, you need prices above $60.
Above $60.
Well, let's remember that maybe half that 500,000 is not the normal oil field response.
Right.
And whatever, this is the DUCs, the drilled but uncompleted wells. And some of these have actually been fracked, and they're just waiting hookups. I mean, the problem in the Bakken has nothing to do with the upstream stuff, it's midstream. That the rail rates are just too high for them to move their stuff to the East Coast or West Coast refineries where they used to have an advantage, or even to move it down where there are some pipes going down into the Gulf Coast, which is the prime market. So that needs to be kept in mind.
I need to say that, from my perspective, I see the world a little bit different. That if you have a demand growth of somewhere in the range of 1.2 to 1.5 million barrels per day, which I think is very plausible, and you have a growth in the U.S. coming of in the range of 300, 400,000 barrels per day a year, is fully absorbable in the demand growth. Now, if you have a big recession and demand growth not growing, yes, of course, that would be a problem. But I think I can see very easily that the scenario of $55, $60 oil to be sustainable and doesn't have to go down to $43. It doesn't have to go down. If you say there's no demand growth and there is a big upside potential here or there are bits and pieces here or there. But there are also downside potentials in several places, including Venezuela. Nobody really has any additional volume of oil to produce. Everybody is near max. Libya doesn't come in, and Nigerian, Boko Haram issues don't get resolved. I think that we can easily exaggerate the impact of what the U.S. can do to the global market. Because if the U.S. comes in there with 300,000-400,000 barrels per day, it doesn't matter, it can be absorbed. If the U.S. comes in 1 million barrels per day, yes, it can make the back of the market.
Well, November 30th is important, but we're right on the brink of probably more important than the 28th and the 29th, Friday and Saturday. The first day is going to be an OPEC meeting. The second day is some non-OPEC, unstated so far, people are going to come in. And I really changed my mind over the last month or so about this the probability of agreement. And it started with, is there enough commitment? The commitment is there. You know, I spent a while with Mohammed Burkindo. This is a career maker for him. If it had been Al-Badri still as the Secretary General of OPEC, maybe there would have been a lot of dancing and nothing happening, and then it'll be the 30th, and they'll say, okay, well, we got the psychological rise, and it's over. But commitment's only the first step. Then you got to do the details, and that's what this meeting is about. And that's hard. Once you got the details, then you've got the implementation and how that's going to work. Now remember, there are now 3 exemptees rather than 1. It used to be that you left Iraq out or 2, and then you left Iraq and Libya out. Now you're leaving Iran out, you're leaving Libya out again, and you're leaving Nigeria out.
Except that Iran cannot do anymore. I give you an exemption, something that you can't do.
He's from there, so he knows, yeah. But Libya is saying that maybe they're going to be producing 900,000 by the end of the year. It's not Boko Haram, by the way. It's the Niger Delta Avengers, the ones that, and they just blew up Escravos again with Chevron. So they haven't gone away. They're not about to go away. So I think you've got this going on with Nigeria, but what do you do in that month where they all kind of show up and Iran does get a little bit more out? And you know, who's going to eat that? Well, if you do it proportionally, which what the old plan was, you're going to have some complainers in that. If you don't do it that way, then you get Saudi Arabia playing swing producer, which they may be willing to do, but they don't want that to be sort of their public role. The thing that nobody's really said yet, in my price forecast, is I think there's going to be enough doubt about the effectiveness of the implementation. I'm more of an optimist about the U.S. turnaround. I'm concerned about the shape of the forward price curve, which brings more oil into the market from liquidation of reserves. So I see prices lower in the first part of the year, and then I see them increasing at the end of the year because I think the Saudis are going to be talking up and talking up and talking it up in advance of the IPO. And once the IPO is over, then we're into the world.
The IPO is in 18.
In 18. I know, but this is the end of 17. I think you see a price rise is important.
I don't think there'll be IPO in 18. I don't think IPO in 19 or 20 either.
Okay.
But at the end, you know, I want to say that
I vote we go to questions from the audience.
if you go in this environment and we have this...
You lose 1-1. I think I'm going to let you finish it anyway.
We go in this environment and we have the volumes. I think OPEC doesn't have to reach an agreement. All OPEC has to do is to pretend to reach an agreement in the end of November and say that, look, we have an agreement in principle, we're going to define a price band, defend the price band, but we are not ready to say exactly what the price band will be, and we'll do it next year. Allow the market demand to absorb some of the extra volumes. I'm convinced that by the middle of next year, there'll be drawdown, serious drawdown of inventories taking place in the market. And the time will be right to reach an agreement. But you don't have to have an agreement in November. All you have to do is to pretend.
Okay, that's a good final point there. And please identify yourself and your affiliation, even though we may all know you. Jim Smith, current president of the IEA. Would you identify yourself and tell me?
Dave Knapp, president-elect of the IAEE. Thank you. How you identify yourself?
Yeah, exactly.
I love the conversation, and I've heard everything that's said, but I have a problem in digesting the information, or even the disagreements, which may or may not be hard, because
So we succeeded.
I'm trying to see we succeeded. Record time. What is the meaning of rebalancing? We hear, somebody writes the market's going to rebalance in the third quarter of 17, or maybe it's not until the fourth quarter. How will we know? What's the criteria of rebalancing? Are there 3 statistics that we look at, and when they get a certain configuration, we can say, okay, now we're rebalancing. I don't know what it is or how we will ever know that we're rebalancing.
The number one thing you look at at is the shape of the forward curve. As soon as you go in below full carrier, which means front end spreads, 70 cents on WTI, and probably I would say somewhere around 35 cents on Brent. Brent just blew out, the front end spreads just blew out to over $1, which tells you that the market's contending with a relatively large surplus. So once those margins, I mean, it's not, I mean, just simple economics.
So what percentage of trading days do we have that balance in the forward?
There's no,
50%.
the only time you got,
over the past 15 years. So is that a balance, or is that just a momentary circumstance?
Jim, it's 52 days is sort of a trigger for OPEC policy in the past, but that's just OECD inventories. OECD inventories are nowhere near as important as they used to be. Non-OECD inventories are still somewhat non-transparent. And China is such a huge part of it. That's why I say they're the Saudi Arabia of the demand side, including inventories. And we were talking to people about that. But the measurement is easy. We add up all the demand that we see out in the world, and everybody kind of agrees. I add up all the supply I see out there in the world, and I get more. And so I get a surplus. That's surplus number one. Then we look to see what's been happening for the last year and a half, and you add up the hundreds of millions of barrels of surplus inventories that have accumulated. That's the second part that needs to be addressed. And then you end up with a base type thing that we've tried to define. We think it's maybe about 500,000 barrels a day of oil that's going to be dead oil. It's stuff going into the SPRs, and not just China, but now in India, and eventually it'll be in Philippines and a couple of the Southeast Asian countries. And it's just oil that's going to liquefy these new growing oil economies of the developing world. It's pipeline fill, it's tank bottoms, and that kind of stuff. And all that adds up so that if you can get the surplus down to 500,000 and you work through all but 500,000 of what's there, then to us, that, I mean, I think it's a very strict, you can quarrel with any of the details of it, but that's how the rhythm's.
So I understand you to really be saying more or less that the inventories get to a normal level. But I don't know what the normal level is.
Yeah, can I correct that? So you got one answer. One answer is the watch the carry, watch the spreads, watch the futures curve. Second answer is watch inventories. I don't think it's a level of inventories. The markets will react to the change. So when inventories go from accumulating, which they still are, to not accumulating or actually descending, then that would be the signal.
the curve flattens out and what happens. And you've got four curves you can look at. By the way, Dubai is in backwardation right now, so it's tight in the Arab Gulf. And why is it tight? We just had Canada and Nigeria take a lot of supply off the market. The high frequency inventory is in balance right now.
And Canada's back and Nigeria isn't, so. I said Canada's back.
Yeah,
Nigeria
Canada's back,
isn't.
which is why we're bearish.
Like the wildfires, yeah.
Yeah.
Thank you.
Okay. Yes.
And that's what my opinion of the budget. The first point is that it is possible for a country like Saudi Arabia, Kuwait, or others to reduce production but increase exports.
Yes.
So in a sense, we have to focus on exports, not production and the chain. On the Iran oil view, if it is going to happen, then we have to look at whether it will happen within Saudi Arabia or Saudis, or it will be outside Saudi Arabia. And that's when we talk about the prices of the Saudis want higher price or valuation or lower price. If you look at the history of privatization in Saudi Arabia, all the major companies that were privatized were undervalued. And then after the IPO, the price went up, and everyone, especially the richest people in Saudi Arabia, is going to get money. So in a sense, if it isn't viewed in Saudi Arabia, it is in their interest to keep prices low, so everyone can make money. The outside doesn't be a different story.
Next.
Marian, comment to your comment.
Chief economist is economist.